Welcome back to this week's market update. Today is September 15th, 2023, and we have a very full week, so let's jump right in. As of Thursday, markets found a little bit of solace this week as equities rose slightly amidst a backdrop of sticky inflation data, an exciting IPO in the tech industry, and a record-breaking inverted yield curve this week. As of close on Thursday, September 14th, the Dow Jones Industrial Average gained about 0.7%, the S&P 500 gained about 0.4%, and the Nasdaq was up just about flat. Switching gears right into our news of the week, the August CPI print was definitely one of the biggest data points of the week, where we had headline CPI for the month of August surprise economists to the upside, clocking in at an annual rate of 3.7% in that headline metric. This was up 50 basis points from July's lighter 3.2% inflation rate. On the other hand, core CPI that excludes food and energy settled to an annual rate of 4.3% in August, down slightly from July. On a month-over-month basis, CPI was up about 0.6%, while core CPI rose a slimmer 0.3%. However, the monthly data came heavily skewed by just one category, energy. So we'll jump into kind of the underlying factors of the CPI print next here. As I was just saying, the energy category led inflation higher in August, marking a 10.5% monthly increase in the cost of energy commodities in August. This might persist as Saudi Arabia claims to be cutting production by about 1 million barrels per day through the end of December. So we might see higher oil, gas, and all those sorts of things, all those sorts of prices higher through the end of the year. Other categories driving CPI higher on an annual basis included transportation services up over 10% from a year ago, as well as shelter up over 7% from a year ago, and food away from home up over 6% year over year. On the contrary, used vehicles were down about 6.6% from a year ago, as well as energy overall compared to last summer, and medical care services were also down about 2% from a year ago. This higher CPI print from August may largely be a result of the geopolitical pressures driving energy prices up. However, we will continue to monitor these inflationary data as they come out to best execute portfolio decisions. Along with the CPI, we also got the PPI, the Producer Price Index for the month of August, rose almost twice as much as analysts were expecting at a monthly amount of 0.7% compared to July. We had core PPI come in at just 0.1%, so that was a little bit lower there. And on an annual basis, August PPI headline was 1.6% year over year. So not quite much on that front, and it ticked up to 3% on a core year over year basis. Then we also saw the energy prices really put that upward pressure on producers this month as well, up also 10.5% month over month in the energy category, along with higher transportation and warehousing costs, also driving the PPI up on a month over month basis. Food costs to producers fell actually about 0.5% month over month in August, while trade costs also fell a little bit there. So interesting stuff between the CPI and the PPI as consumers and producers are both facing a lot of upward pressure in energy prices. Throughout our week, the August retail sales came in stronger than expected at a monthly increase of 0.6%. This was only up 1.6% from August of 2022, but it did total 697.6 billion, so not slim at all on that front. Food services and drinking establishments led sales higher, up 8.5% from a year ago, showing consumers' continual preference for service and experience-focused spending. As we near October, when the student loan repayments will reenact for many borrowers, it will be really interesting to see how retail sales and just overall consumer activity begins to shift, or if it will shift at all. Final piece of updates of the week, we broke a record this week in the yield curve, the longest time that the 10-year minus the 3-year yield curve has been inverted. It was up 212 consecutive days as of Thursday, September 14th, and historically an inverted yield curve, one where short-term yields are much higher than long-term yields, has been a telltale sign of an economic slowdown to come. In fact, over the last 60 years here, you can see that every time we had these blue lines here, you can see a red line followed, which that's a recession there. We have a little bit of blue here, then we have a recession. Then we have a little bit of blue here, the inverted yield curve, then we have a recession. So right here, we have a lot of bit of blue, a lot of bit of inversion in the yield curve. And obviously that has a lot of other factors such as COVID and the really rapid rate hikes that the Fed has implemented over the last year or so. But will there be a red section to follow like it did in all of these other economic periods? Now, again, this is no guarantee of economic conditions to come. However, it is usually a pretty accurate leading indicator that economists will tend to look over in these sort of uncertain economic eras that we find ourselves in. So continue to watch the yield curve, treasury rates, and all those sorts of things as we form our view on the economy. So that was our update for the week. Thank you so much for tuning in, and we look forward to providing another update next week.